Hi class, welcome to chapter 7. We'll be talking about the capital asset pricing and arbitrage pricing theory. These are very important topic concepts within investing. I would say their use on a day-to-day basis is probably little, but it's an important foundational concept that kind of underlies many components of investing from an academic perspective. When I'm thinking about a stock or an investment, I'm not necessarily calculating the CAPM model to determine its valuation. That might be a strategy for other investors, but for me, this ends up being kind of more academic, foundational knowledge than practical day-to-day techniques. So let me share the slides with you for today. Capital assets pricing model, security required rate of return relates to the systematic risk measured by beta. Right here, we see what the beta of the stock is. Then there's also the market portfolio. Each security held is in proportion to market value. So when we're looking at a market portfolio, it assumes the index is market cap weighted, which means the biggest stocks have the heaviest weight. So if you look at something like the S&P 500, Facebook, Amazon, Google, Apple all make up, around 5% or more of that index. Some assumptions for the capital asset pricing model. All investors are price takers. All information relevant to the security analysis is free and publicly available. That is not necessarily always true. All securities are publicly owned and traded. No taxes on investment returns, no transaction costs, and lending and borrowing at the same risk-free rate are unlimited. Those are some big assumptions right there. There's also some investor assumptions that investors plan for the same single period time horizon, that investors are efficient users of analytical information, and that investors are rational and mean variance optimizers. And again, those are some big assumptions there as well. Hypothetical equilibrium. All investors choose to hold the market portfolio. Market portfolios on the efficient frontier, optimal and risky. Again, do all investors hold the market portfolio? No. So these are, what I would call, like problems with the model, is because we're all not efficient asset allocators and optimizers of our portfolios, right? A lot of people buy stocks and just sit on them, right? Never sell them or buy or buy. Hypothetical equilibrium. That's the risk premium on the market portfolio. It is proportional to the variance of the market portfolio in the investor's risk aversion. So the variance of the market portfolio is also backwards looking. So that's a measure of variance leads to standard deviation, which is a measure of volatility. The risk premium on an individual asset, relates to also, historic volatility of that asset, proportional to risk premium on the market portfolio, and proportional to the beta coefficient of the security in the market portfolio. The beta of a security, really important concept here, is its historical price sensitivity to the index. So if you have a stock with a beta of 2, you would expect it to go up 2% every time the market goes up 1 on average. And when the market goes down 1%, you would expect the stock to drop 2% on average. A high beta means a high sensitivity to the market. This is just a visual of the efficient frontier and the capital market line and where they intersect. A passive strategy is considered efficient. So when you think about an S&P 500 fund, one I use a lot is IVV. I think that's one of the lower cost ways to invest in the S&P 500. Under mutual fund theorem, all investors desire the same portfolio of risky assets and can be satisfied by a single mutual fund composed of that portfolio. Now that actually, there's a lot of truth to that statement because many investors can satisfy their risk exposure with one asset. There are a great deal of ETFs out there that are just broadly exposed, market cap weighted to either the global stock market or just the US market, as well as a handful of other countries. So you can get that efficient exposure either globally or based in the US, pretty efficiently. Most people want more than just, the one line item, even though it's diversified within that line item. A lot of investors just see the one line item and think it's concentrated. If passive strategy is costless and efficient, why follow an active strategy? Well, one reason is if no one did security analysis, what brings about an efficient market? So the people who are willing to take risks and be right or be wrong are the ones who also make the market efficient. The more people who go passive, the easier it is to beat the market. The risk premium of the market portfolio, demand drives price, lower expected rates of return, and risk premiums. When premiums fall, investors move into funds, funds into the risk-free asset. You want a high premium to own a risky asset, right? If there's a low premium to own a risky asset, that means you're not getting a lot of return for the risk you're taking, therefore don't take the risk. Equilibrium risk premium of the market portfolio is proportional to the risk of the market, and then also the risk aversion of that average investor. How risk averse are they? Expected returns on individual securities. Expected return beta relationship. So implication, the CAPM model that security risk premiums, expected excess returns will be proportional to beta. So we see here the expected return equals the risk-free rate multiplied by beta, or the sensitivity of the difference between the market portfolio and the risk-free rate. The beta is for that asset. So if we're looking at Home Depot stock, the beta would be the beta for the Home Depot stock. Everything else is in relation to the market. So really what the CAPM model prices stocks on is their historical volatility based on the market. So it's not a very complex formula when you think about it. The only input from the actual stock is the beta. The rest is the risk-free rate, which shows up twice, and then the expected return on the market. The security market line represents expected return beta relationship of the CAPM, graphs individual asset premium as function of asset risk, and then alpha is the abnormal rate of return on the security in excess of that predicted by the equilibrium CAPM model. So you're going to get alpha if it does even better. How could a stock do even better? How would you predict that? Could be look at the beta of a stock, which I would start with. This is, again, very simplistic analysis. And there's potential where a stock used to be risky and would have a high beta, but maybe something changed in that security where it's no longer high risk. One topic I've chatted about with you guys before is the market for microchips. It used to be really volatile because essentially it was driven by desktop sales. Now that microchips used in everything, they're not as cyclical related to just to desktops. Everything from your car to your thermostat now has microchips. So I might say microchips historically were volatile, but now we're no longer so. So I'm predicting lower volatility or a lower beta than the market's predicting, but there's still a high risk premium. So effectively I'm saying I'm going to get a higher return and lower risk. And again, that's the visualization of the security market line in a positive alpha stock. Applications of capital pricing model. The use of the security market line as a benchmark for a fair return on risky assets. SML provides a hurdle rate for internal. So if you're looking at a CAPM pricing model to price like not necessarily a security, but a product or a process or a project, it can be used there as well. Index model, realized returns and mean beta. So the RIT is the holding period return, and minus the RFT. FT is getting to that. Holding period return, sorry, minus the risk-free rate. Took me a second there, guys. Equals the intercept of the security characteristic line. And again, that intercept of the security characteristic line, that's code word for risk-free rate. This is just making it look confusing. The BI is the beta again, and then it's RM minus risk-free again. So return to the market minus risk-free rate. It's adding another factor here, and it's called firm-specific effects. You'll often see that in other financial models as like an error term. It's like a fudge factor. It's what happens to the security that's not explained by the beta. Estimating index model. And again, you're seeing a lot of the similar formulas here. Excess return is the rate of the asset minus the risk-free rate. That's for the excess return. So this is turning out to be a formula that calculates the actual return. What did you get for the return versus the predicted return, right? So, and here's just a visualization of returns for various assets over a period of time, how well they've done, how poorly they've done. We can see different measures of volatility, standard deviation. Google has the higher standard deviation of 10.4, but it also has the highest average excess return. So, that's a key factor there, right? You're getting higher return, but you are accepting higher risk. So, very important characteristic there. And again, this is just showing the monthly returns since from 2005 to 2010 for each of those assets. And you can see that the highs of Google are higher and the lows are generally lower, right? But not over all periods. I guess that's what makes Google a great investment, is that the highs appear to be higher and the lows are never too low. So we do see at the end of this period, between 2005 and 2010, that the S&P 500 and Google break pretty close to even. And this is a cumulative monthly return. We see it on a cumulative basis. That small advantage that Google had adds up to be a pretty big difference. So when you just look to separate the monthly returns versus the cumulative returns, Google provided close to a 50% return, while the S&P 500, and I'm sure they're cherry picking a time period, provided more of a 6 to 7% return here. This is a scatter plot diagram of where Google was in relation to the market in terms of excess rate of return, and on the market against excess rate of return on Google. Going back here, this is calculating a T statistic, so estimated value versus hypothesis value divided by the standard error of the estimate. So that's another standard deviation measure. And it's right saying here the T-score equals 0.94. So this is just a regression analysis. Typically these would be done by a computer, not by yourself. Standard error, right? That's a volatility, key term right there. And the coefficient is typically where it intercepts the risk-free rate. Next, security characteristic line. Plot security's expected excess return over the risk-free rate as a function of excess return on the market. The required rate is the risk-free rate plus beta multiplied by expected excess return of the index. So if you'll notice, that second bullet point there is actually telling us the CAPM formula, risk-free rate plus beta multiplied by expected excess return. They're showing us the CAPM model again here for like the 10th time in this chapter. Predicting betas, generally betas move towards the mean over time, which means betas should move towards 1 over time, meaning eventually high betas move to low and low betas move higher. There is a mean reversion. It has to do with the sensitivity of that stock to the market, and then what time period of the market are we in terms of what stocks benefit. CAPM is false based on validity of its assumptions, because it's a useful predictor of expected returns, untestable as a theory, but the principles are still valid. Investors should diversify. Systemic risk is the risk that matters. And then well-diversified risky portfolios can be suitable for a wide range of investors. This is where it gets a little bit more interesting. This is what we would call an extension of the CAPM model. So instead of just having that one beta for the market return, you could have multiple betas and one might be the market return, but you might say, oh, is there a beta for a small cap stock? Like, is there a sensitivity factor for being a small cap? Is there a sensitivity factor for being profitable? Is there a sensitivity factor for being trying to think of another one, for having good environmental policies? And you can effectively try to make a model. Who knows if it will work, but you can make a model that will try to predict prices with multiple betas. It could make it more accurate. It could also make it more complex needlessly. The FarmerFrench model is a very famous model. It talks about three aspects of successful specification. Well, let me just talk about that for a second. It's the same as a CAPM model, but then it has a factor for value stocks as well as small stocks. So they believe that the small factor and the value factor, have meaning in addition to the risk premium. This is showing the total, just a bunch of data. I won't spend much time on this slide. Regression statistics for alternative specifications. So this is looking at a single index, the S&P 500, the broad market, and the FarmerFrench three-factor model. It has a correlation coefficient. The correlation coefficient is how correlated it is to the broad market, right? So when the correlation is lower, that means that there's a bigger benefit to diversification. If there's a high correlation, it doesn't really bring much diversification. It's also here with the three-factor model here. The difference you see here is you see the book-to-market beta, the size beta of 0.2, and then the market beta, the risk premium beta of 1.51. So that's just showing you a little bit of a difference when you use the three-factor model. Arbitrage pricing theory. Relative mispricing creates riskless profits. So risk-return relationship from no arbitrage considers in large capital markets. Well-diversified portfolio, non-systematic risk is negligible, meaning there's not a lot of company-specific risk because you're diversified among sectors. It's difficult to have an arbitrage portfolio, and positive return near net investment in a risk-free portfolio can happen if you have arbitrage opportunities. So arbitrage is effectively a risk-free return, but if other investors see an opportunity for a risk-free return, what do? The market eventually sees it and then starts piling in. These formulas right here, right, are effectively what? The CAPM formula. One up here has the error term, right? But effectively, this is the CAPM formula all over again. Step to convert a well-diversified portfolio into an arbitrage portfolio. Effectively what this is saying here is that you borrow at the lower rate and invest in the higher rate, right? You borrow at a lower rate and invest in a higher rate. If one bank is offering you a 0% loan and another bank is offering you 1% on deposits, just loan as much money as you can from the 0% bank and invest it into the bank that pays you 1%. All that's free money. Old because these have significantly changed in the weights of these stocks, especially Apple, Microsoft, Google are much higher than they were when this was produced in 2017. So it's a regression statistic for the S&P 500, talking about the number of observations, the period return, the coefficients, the standard error term, and the t-test. We'll just move on from this slide. Annual standard deviation. So how risky was the market, right? You saw a standard deviation right here between 2006 and 2010 of about 1.46, and then from 96 to 2000 about 0.6, and then 86 to 90 about 0.86. Multi-factor generalization of arbitrage pricing theory and CAPM. So these are all factor portfolios. Well-diversified portfolio constructed to have a beta of 1 on one factor and a beta of 0 on any other factor. Two-factor portfolio model. So you have one that has the market beta, and then the second factor could be anything you want, right? Any other factor that an investor wants to try to capture. These are not perfect predictors. This is more of an I've seen more investors using this in reverse, meaning they have a portfolio and then they kind of go backwards and deconstruct it as factors to try to explain, why what it is. Like, oh, small cap stocks hurt us and value stocks benefited. And this is just showing you an example of, each factor with each specific beta to calculate that formula, right? So it's risk-free rate times beta multiplied by factor, then beta 2 multiplied by factor, then plus beta 3 multiplied by factor. And that's the end of this chapter. A little bit complicated. The CAPM pricing model really flows through this entire chapter. You see it multiple times. It's just a formula I would become very familiar with. If you continue to pursue finance, it is a core foundation formula, even though it's not used on a practical day-to-day basis. So CAPM model, risk-free rate plus the beta multiplied by excess market return, which is the the return of the market that's expected minus the risk-free rate. And again, there's a lot of variables in that equation, meaning, how do you know your expected return on the market is even what the market ends up returning? There's a lot of areas where you can plug in the wrong information in that model. On that note, guys, I'll see you next week.